The most important variable, again, I'm going to come back to AI over and over again, because we think that is going to represent $30 trillion in market cap during the next 10 years. And we are just beginning.
Hello and welcome back to another video. In this video, we're going to be analysing Teladoc. They are a clear leader in telemedicine, which is a fast-growing industry with various tailwinds behind it. The stock has dropped over 30% from its high, but regardless is still priced for aggressive growth. And we're going to find out in this video if there is enough room for this growth in the years ahead, or if the valuation makes sense. Now, this is going to be a quick analysis rather than a real deep dive into Teladoc and its products, but I want to screen the stock and see if the recent dip makes for a potential buy or not. The main reason why it's been selling off so aggressively was due to the guidance given for new signups and the worse than expected loss in the 2020 and Q4 reported earnings. The CEO actually cleared up some of the concerns around guidance on CNBC that led me to believe their guidance is somewhat pointless and they like to under-promise and over-deliver.
Quarter, terrific growth. Obviously, you've been a big benefactor of this switch to telehealth over the last year, the acceleration of it. But one of the things that I think investors are trying to sort out is your guidance. On the one hand, you ended the year with 51.8 million paid members, but you're only forecasting 52 to 54 million for 2021. That seems like really small growth given the opportunity.
I think when you look at our growth, we doubled revenue last year and we're forecasting that we'll double revenue again this year. I think that underscores the strength of how much that vision resonates in the marketplace.
And yet you're only forecasting growth of up to maybe 7% in terms of paid membership. Are you just setting the bar low?
Well, you know, if you look back at last year, we doubled our guidance in terms of our actual membership adds. We added 15 million members, which was more than double our initial guidance. And so we take a very deliberate and I would say conservative view of how we forecast, and that served us well. I mean, we've met or exceeded our revenue expectations 22 out of our 23 quarters as a public company, and so we're going to stick with that forecasting methodology. And I think we have a ton of upside as we look into the back half of this year and very much into 22.
So we can take those estimates with a pinch of salt, but ideally I'd like to see accurate guidance from a CEO rather than admittance that you might be sandbagging. And our analysis on Teladoc will include trying our best to understand the business and why it's a major disruptor, analysing its potential for growth in the years ahead and ideally put a firm number on that growth, and then checking the financial health of the business and assessing, more importantly, its most recent acquisitions and how that benefits the business. And as usual, we will try our best to put this into a realistic valuation and then give you an estimate for a fair value to buy Teladoc stock today should you be interested. Firstly, let's discuss the business model. So they are a multinational telemedicine and virtual healthcare company based in the US. Their primary services include telehealth, medical opinions, AI and analytics, and a licensable platform service. For those of you who haven't heard of telemedicine, it's the use of electronic communications and software to monitor and treat patients instead of an inpatient or in-person visit. Of course, this is a disruptive model in the sense that it allows for more flexibility in mostly availability for visits as demonstrated during the coronavirus outbreak, and is on the face of it a more efficient way of delivering medical care. It's previously been a fast-growing industry, boasting a 35% compound annual growth rate in revenues during the past 5 years alone. Its adoption in society has been boosted in a major way by COVID, as you would expect, and that growth is not expected to stop, with revenue expectations for the total addressable market to reach $175 billion by 2026, which is over a 3x from today. As for Teladoc, well, they essentially take a fee for facilitating virtual visits and health checks. They have an asset-light business model through this, providing a third-party platform. And the added benefit being that the majority of revenue is subscription-based and therefore operates as a SaaS model, although they're not your typical SaaS business. And we've covered that before. This makes the business model special because you get recurring revenue streams, which allows for revenue to compound at a quick and easy rate as long as retention is good and the product is also. Teladoc recently took advantage of their chunky valuation and acquired another business called Livongo that complements their business model very well. The purchase was $18.6 billion, so a very chunky acquisition. But here's what Cathie Wood, who's a big bull on Teladoc, had to say about it.
Well, we had a great opportunity to buy into Teladoc, and it then was hurt by an acquisition it made, Livongo. This is a beautiful acquisition for Teladoc. The most important variable, again, I'm going to come back to AI over and over again, because we think that is going to represent $30 trillion in market cap during the next 10 years. And we think the combination of Teladoc and Livongo is going to be a powerhouse. One services more the acute setting in medicine. That would be Teladoc itself primarily. And Livongo is more involved on the chronic side. So chronic conditions, kidney conditions, mental health, and so forth. So we believe that with this data, these two companies, now that they're together, now that they put their AI teams together, are going to be able to help make the healthcare ecosystem better, cheaper, faster, more productive, more creative. What we say about all kinds of innovation, they're in a beautiful position to do this.
So as Cathie Wood alludes to there, their business is about much more than just facilitating visits for healthcare services. They provide AI, data, and software services that manage all parts of the healthcare cycle. And as you may know, ARK Invest and Cathie Wood are one of the biggest bulls on Teladoc. It's their third largest holding in their main ETF, and their holding has a market value of $1.4 billion. Cathie has gone out of her way on many occasions to talk about how Teladoc is poised perfectly to take advantage of the tech AI healthcare revolution in the coming years. So I want to see exactly what Cathie Wood is seeing from this investment from a financial perspective. And I want to do a quick screen of Teladoc stock just to get an idea of where a good entry price might be for the stock. And this is based mostly off of the guidance that they gave on revenue growth for the years preceding 2020. Before we jump into the forecast, just want to take a look at the historical financials and just glance over those quickly. So strong revenue growth as you would expect. Gross margins at 68%, like I said. Operating income, they found it hard to make any money, and they actually made a very big loss in 2020. But a lot of that was down to the acquisition that was made, and could be a very beneficial acquisition, especially for the long-term growth and sustainability of the company. Now, you can see that investors or shareholders of Teladoc paid for that acquisition mostly, with shares outstanding jumping from 72 to 128, and that's in millions, that is. Cash has grown slightly over time, but you'd expect with that shares outstanding growth, you'd expect some cash to at least be delivered to the balance sheet. Debt has grown as well, so they obviously took on some debt to make that acquisition. $1.4 billion we're at now, which is a little bit concerning considering it's higher than revenue, but the market cap that they've got currently, I don't think they'll have any problem writing off some of that debt from raising more capital, although it will mean those shares outstanding go up again, which is not what investors want to see. In terms of their asset value, though, you can see that's increased by a substantial amount with that acquisition. So we've now got 15.8 billion shareholder equity from that acquisition, where it was just at $1 billion before. So technically the asset value is a lot better for Teladoc post-acquisition. Now, for the forecast, I've gone with their guidance in 2021, which is essentially to hit $2 billion of revenue. They said they could double, but 90% gets us to $2 billion of revenue. And then their long-term guidance, at least up to 2023, was somewhere in the region of 30 to 40% compounded for the next 4 years, that was. But we know they do like to sandbag, or at least they've admitted they like to sandbag, so it could be higher than that. So I've gone at the upper end of that estimate. So that's 42% revenue growth over 5 years, and that gets us to almost $6 billion of revenue in 2025, which, as you can see here, isn't a gasping amount of market share. Only 3% of Teladoc's 2026 total addressable market. So I'd take these as conservative estimates, as it does seem like they like to lowball their guidance into the future. Now, this was the hard part for me, estimating a fair and reasonable operating margin and free cash flow margin. I'll be honest with you, I really didn't know what was the best metric to go for. I can see they can be profitable with scale, And once these acquisitions start to play out a little bit more, they've got a high margin profile. They're an asset-light business model. So I think somewhere in the region of 15 to 20% in the long term is a fair margin for them. So I've gone with 20% on both free cash flow and operating income, but not getting profitable until at least 2023, when the most of that growth stage is out of the way. Shares outstanding, I think they're going to have to raise capital going into the next 5 years, especially with that debt they have on the balance sheet and the amount they're losing at the moment, $418 million a year on the bottom line. So they're going to have to raise some more capital. I think we're just going to have to accept that. So I've gone with 2% per year, which is actually a fair amount considering how much they raised last year. And then my terminal values, I've gone with an EV sales multiple of 10, an EV EBIT multiple of 30, which balance each other out slightly. I think 10, I went with an EV to sales multiple just because of that unknown aspect of the margin profile of the business. And then a 30 times EV to EBIT multiple, because that would be the going multiple for the type of growth that they're achieving in that period. The perpetual is there just to give us a little bit of indicator as to how fair our terminal value is. So the perpetual growth method at 4% comes at around 50 billion for a terminal value. We're at 46 billion. So that hints to us that we're being quite conservative in our estimates. Now, let's get into the DCF. So that gives us an enterprise value of 47 billion. We less the debt plus the cash, and that's a market cap of 46.6 billion in 2025, or a price target of $329 per share. That's only a return of 1.7. So just know off of that, with a discount rate of 15%, that means the stock is overvalued by about 25%, 24%. Gives us a target price to buy based off of these estimates of $150 per share. It's currently at 198, but you never know, it could drop down to that level. I think the last time it was around that level was back in April of 2020, which was the coronavirus. So it really took off from there, as you would expect. But it's been dropping and dropping. Looks like it's trailing back up, although very slowly, 12% up from its bottom in March of this year. But we could see a drop again. Just want to show you, though, how sensitive this valuation is based off of the revenue growth and the margins of the business. So if that growth doesn't slow after doubling again next year, and we have 50%, 50%, and then just 30%, getting us to 8 billion in revenue in 2025, keep the multiples the same or the terminal values the same, then we get a stock that's fairly valued. And a 15% rate of return, it looks like Teladoc could be a good buy. So these really are sensitive to the assumptions that you put into them. So I would suggest you do your own research on Teladoc, come up with what you think the growth outlook looks like for the company in the next 5 to maybe 10 years. Again, if I stretched this out to a 10-year valuation, then you may get a different intrinsic value just because we're letting that growth play out. But unfortunately, past 2025, our visibility isn't as clear. So that's about it for this one. Just a quick video on Teladoc. I wanted to screen the company quickly for you, screen the stock, and give you an indicator as to what price might be a fair one for Teladoc stock today. Healthcare isn't exactly my forte, and it's not something I have invested in, at least recently. So I'd advise you can use a valuation model like this and put your assumptions into it, see what intrinsic value you get based off of your knowledge for Teladoc, and then go from there. And that's about it for this video, guys. Thank you for watching. I'll see you in the next one. Good luck with all of your investments.